network is a derivatives primitive. But in order to truly understand what Hxro does and to understand the types of applications that can be built using Hxro's infrastructure, we need to start with the basics. Let's talk about what derivatives are at a high level and the important role that derivatives such as futures and options play. Derivatives are contracts that derive their value from one or more underlying assets or benchmark. This is commonly referred to as the underlying. The most common underlying assets include commodities, currencies, market indices, interest rates, stocks, and bonds. However, while primarily viewed within the construct of financial markets, even items such as, say, concert tickets, events such as political elections, or even weather conditions can be used as the basis for a derivatives contract. Derivatives can be traded privately OTC, which means over the counter, or on an exchange. Historically, OTC derivatives constitute the greater proportion of derivatives in existence and are usually not fungible. Derivatives traded on exchanges, however, are both standardized and fungible. The amount and value of underlying assets increases over time as the global economy continues to expand. Derivatives markets have expanded accordingly, as they are the most effective and liquid instruments to manage the price risk associated with this continuously growing basket of underlying assets. Let's cover 3 of the key reasons for the formation of derivatives markets. 1. Hedging risk exposure and obtaining custom payoffs. One of the key reasons that derivatives are used to carry out advanced investment strategies are because they enable various types of entities to manage their business and financial risks. Let's use airlines as an example. An airline sells flights in advance, but doesn't know how much jet fuel will cost in the future. The airline can use derivatives markets to help hedge their risk exposure. Jet fuel is made from oil. The airline is able to isolate risks associated with an unpredictable, drastic change in oil prices in the following weeks and months by buying a future on oil. By isolating the risks associated with oil prices and the impact it would have on their bottom line, the airline has the ability to, within reason, hedge a major risk, as well as project associated costs with future flights, organize more flights, and price tickets more appropriately. Their customers will know they're reliable. In other words, they won't cancel flights when oil prices go up. The airline's cost of capital when financing planes and other operations is lower because the airline was able to mitigate a massive downside risk that could put those loans in jeopardy. Overall, this results in a more productive and efficient economy. Now, instead of worrying about oil prices, the airline's risks are now isolated to their core competencies, getting people where they need to go when they need to get there safely. 2. Make underlying markets more efficient, complete, and liquid. As noted in the previous example, derivatives lower the unforeseen costs of purchasing an asset outright. By using derivatives contracts, one can replicate the payoff of the assets. Therefore, the price of the underlying asset and the underlying derivative tend to be in equilibrium to avoid arbitrage opportunities. Introduction of derivatives of the underlying asset also increases the opportunity set available to investors and hence improves the liquidity of the underlying. As we know, better liquidity motivates more investors to participate because their transaction costs and pricing uncertainty go down. 3. Provide access to unavailable assets in unique markets. The ability to create derivatives contracts for virtually anything allows users to access assets and markets that wouldn't otherwise be accessible to them. Of course, there are 2 sides to every coin. The use cases for derivatives cannot be mentioned without also addressing the associated risks. Derivatives allow investors to gain exposure to an underlying asset without purchasing the underlying asset outright. Derivatives offer investors the opportunity to control a sizable contract value with a relatively small amount of money. While this does present a much less costly way to manage risk up front, leverage is a double-edged sword. As an example, if you buy Bitcoin for $17,000 and it goes to zero, you still suffer a huge loss, but your counterparty got paid the $17,000 and the system at large is not at risk. However, if you buy a Bitcoin future for $17,000 and only have to put up $1,000 to do so, there's a problem if it goes to zero and you don't have the $16,000 to pony up. Imagine taking the scenario a step further, that an event like this metastasizes, resulting in an unwinding of derivatives positions across the market. And of course, since derivatives are not always fully collateralized, this introduces counterparty risk. This is especially important to note for some of the contracts traded over the counter that do not include a benchmark for due diligence. Thus, there's always a possibility of counterparty default. All that being said, this is just the start of our derivatives and DeFi education campaign, so be sure to follow along, ask any questions you have in the comments below, and as always, trade responsibly.